Welcome to the Weekly Notebook Review. I am Robert McGroarty. This podcast takes on a bit of a different format where we are live each week on Twitter Spaces. I crack open my notebook and review Hedgeye research with anyone who wants to learn a better way to invest. We feature both Hedgeye power users as well as some special guests that might pop in. If you want to learn more about our research, visit hedgeye.com. If you'd like to participate in the live stream, follow me on Twitter at HedgeyeRJM. Now, let's review the data.
Good morning. It is about 11:30 a.m. on July 13th. We'll let some folks kind of trickle in here, and then we'll get the ball rolling. A little midday, day late weekly notebook review. All right, look at that. We got a little other side, a little 1,000 FX. Tim Bowes, thanks for joining Trillionaire. Got some great people in the crowds. Appreciate it. And invite, come on up, anyone who wants to speak. But, this is a little bit of a different notebook review. We usually do these after market close or in the evening, but typically, 4:30 on Wednesdays. I had to do a little bit of a last minute shift yesterday, so we're a day late here. It's also mid morning. The summer schedule is just a hair hectic with the kids at camp and birthday parties, pool parties. I've got soccer practice this afternoon at 5 o'clock. So it's, although I intended on doing after the market close, I had to do it midday, but midday is fun. I know not everybody can join as frequently live kind of midday, but I think it kind of lends a different sort of a little bit of a different tone. We're live market hours here, obviously at 11:30 Eastern. We've had the time to kind of digest the kiddie pool. There's been a number of RTAs out of Keith this morning. So lots to talk about. I think just to start off, I think some of the interesting things out of the notebook this morning would be the signal shifts in the DAX, the Google, and the Canadian US dollar. All three went neutral from bearish. So again, that Canadian US dollar, makes a lot of sense given the recent shift in oil alongside the the dollar and dollar weakness at this point in time. But UUP was one of the things that Keith, he went back to the board there, second dot. He only gives himself 3 bullets or 3 dots, however you want to think about it. So typically on that second dot means that first one was timing was off. I got the levels from David Salem, which will be provided to on a monthly basis to the capital allocation kind of subscriber base, and UUP sitting right basically at the tail level at this point in time. So I think from a quad 4 component on the horizon, this is a great opportunity to take advantage of basically this move in the dollar, right? And again, you know that you're kind of sitting right at tail. So if it doesn't bounce from here or kind of regain your tail level, then it's likely something else is afoot in terms of the dollar and kind of what the FX market is sort of how they're positioning dollar versus a number of other currencies. So in terms of the currency side of the house, Euro USD remains neutral trend. US dollar versus Japanese yen is bullish trend. So that's JPY is bearish, and the British pound versus USD is bullish. That's been an absolute that's been a great signal in terms of the pound versus dollar. It's probably one of the best FX signals out there at this point in time. So again, on any kind of weakness, I would be certainly looking to add to the pound versus the US dollar, certainly to perhaps even counteract, again, just to kind of diversify the book. You can play that via ETF as well in FXB versus UUP. UUP, kind of the biggest component in there would be the euro. So it's sitting kind of neutral here is another thing that's kind of like, I would say hurting completely, but just sort of, where it's bullish trade, bearish trend. And it makes up about 60% of the UUP kind of complex. The next biggest, I believe, is the pound and then the yen, but I might have that flip-flopped. I haven't looked at it in a minute. So anyway, but just wanted to kind of touch base on FX. I think if, Mitchell, I see you accepted my invite to speak. How are you doing anything in the dollar this morning? Or are you kind of just letting this kind of 2-day price action sort of breathe a little bit?
I'm letting the 2-day price action breathe a little bit.
Yeah.
Still have some. If it breaks tail, I will cut. If it doesn't break, then I will look to add more once we have more confirmation that things are moving up. But um, you, you have, from what I see, you have some things stretched, dollar stretched to the downside. You got oil looking to, oil going neutral, looking to go bullish. You've got some. They're either counter trend or not, but there are some things that are at extremes. Can't say I get it, but I'll follow the signals at this point in time. So one of the nice things that is finally starting to work again is gold. So we'll see if there aren't all that many questions or concerns about gold, but it seems to be picking up a bid and gaining some strength on a relative basis. I'm sitting tight on dollar. That was the question. So I'm sitting tight on, but we will see. I'm in wait and watch mode.
Yeah, I mean, good segue there because I was going to go kind of touch base on the commodities. So, in terms of oil, gold, it is an interesting kind of complex, right? On a 15-day correlation to the dollar, you've got SPX at a minus 0.26, CRB index, so the commodities themselves at minus 0.73, and then gold at a minus 0.89. So, those are all very inversely correlated. Maybe not as much on the SPX. But that's certainly helping in terms of the commodity complex, right? So
Yeah,
I think this is an interesting setup. I mean, oil in particular. I know Rooster. If you guys didn't catch the Texan Rooster show yesterday morning, he mentioned there, I'm lucky enough that I get it daily from him. But his AI kind of quant model went long on oil yesterday. So he made the comment that it's nice to see kind of the quant model align with the risk ranges and so yeah, so Keith has even kind of took a lot of the oil exposures off the board in terms of XOP earlier this week. Might have been last week actually, but yeah, we kind of we removed a lot XOP from the short side, and the other kind of oil exposures as a general kind of much more of a wait and watch situation. Even energy XLE in that out bucket in the risk range is back to neutral. So
yeah.
and yeah,
I've,
interesting
I've,
complex there.
Hi, I'm Keith McCullough, and I wanted to introduce you to my favorite product at Hedgeye, the Macro Show. Why is it my favorite product? Well, it's my show. I do that every morning. If you want to get ready for the market day, you want to contextualize all the data, you want to make good decisions, then this is what you should be watching. It's a repeatable process that you can deliberately study, measuring and mapping time series to time series of data. So it's not going headline to headline and getting whipped around. It's actually being so much more dispassionate about it and making good decisions that are data driven. So we'd love to have you on our team. Come join us.
Tune in weekdays at 9 a.m. Eastern and on demand anytime. Go to hedgeye.com/research to subscribe.
I've been long XOP for a couple weeks now, which has been a great performer. It's got some good momentum, and just the way, and I have my levels as to where I'll cut it. I mean, I understand quad 4. I'm not discounting quad 4 with what Steiner went over this morning on the macro show. CPI may not be moving down into the back half of the year, may actually be moving up, right?
Mm-hmm.
So, I don't know if market's sniffing out, more quad 3 stagflation. I honestly don't know, but if we're looking at the complex of nat gas up, nat gas bullish trade trend on Keith's system with WTIC and Brent going neutral to possibly bullish with the AI signal going bullish. I don't know the answer to the question, but at the same time, it's definitely something interesting to keep an eye on. Even copper up here. I mean, it's probably teetering on. So we'll see. I don't know the answer to the question. It's still bearish trade and trend, but it has moved up here. So I don't know where Keith's signals flip to neutral on that, but definitely keeping an eye on this part of the complex. It's interesting because you do have demand destruction going on, as you can see in the data. You can see in the export data and the shipping data and the import data and retail sales. So it's definitely interesting to see the weakening consumer continues, whereas the commodity complex is strengthening a little bit, definitely in certain areas. I think ag is still a little bit weak, but I didn't check that this morning. I was in the middle of something and I lost that. But yeah.
Yeah, so great call out on that gas. It's down, a little over 2.5%, or close to 2.5, maybe 2 3/4, what have you. Down two, call it. Sorry, I was a little overzealous there. So down two this morning on that bottom third of the risk range. The top end of the risk range would put in both. I've talked a lot about, basically looking at where the most recent 1 month and 3 month highs are. The top end of the risk range would be, new 1 month and 3 month highs. That top of the risk range is 2.88. Now, on a week over week basis, that top end of the risk range has come down. So that last week was 2.94 on the top end. But the low end of the risk range has basically kind of stayed relatively, I'll call it kind of a bit of a wash. You're up a penny, 2.51 last week versus 2.52. So that's actually kind of a good thing. Again, just a little bit of top end of the risk range coming down, just really kind of signifies a little bit of volatility coming out of that complex from a risk range standpoint. But the fact that it is still a new one, would be a new 1 month high and 3 month high is good. So I haven't actually taken advantage of UNG yet this morning, but I think that's certainly one. I actually hadn't gone down all that way down the list yet. Mitchell in terms of natty gas, but that's certainly one that's been a really top performer here in the last month or so, and I'd be given the fact that it's bullish trade and trend on the signal, definitely has really good solid signal strength here, and down today on 2%. Now it is I call her the Medusa because if you look at natty gas wrong, she'll turn you into stone. But so just from a sizing standpoint, don't kind of follow. I certainly don't follow the traditional commodity rules there. We would have like a 4% on the max side. I kind of cap that closer to 2.5, maybe 3 if I'm feeling lucky, or if it's really kind of oversold or sort of at the low end of the risk range. But just wanted to call that out too. That's a good call out.
Yeah, this is markets are very. I don't know. I've done this a while. They're trading a little bit strange, in my opinion. It's not like we haven't seen things like this before. We saw it leading into 2020. We saw it back in Q4 or right before we headed into fourth quarter of 2018. I think there are a lot of different things that you could come up with. It could be a narrative, whatever. I think you do have the Mike Green dynamic of the passive investing taking over. At the same time, it's colliding with a structure that is unstable and can easily break, right? So, I will follow the signals, right? Right now, there are some things that are showing bullish, right? And there's some things that are showing bearish at the same time. If something breaks structurally, which can happen in a cost of capital environment, you're going to have guys crying on TV in like 3 days after you go limit down. So, it's not like we haven't seen it before.
You saying we're going to see Bill Ackman again?
You will probably see him because he's his favorite, right? Again, and
I just saw him tweet something about Jamie Dimon and how great of a presidential candidate he would be.
I'll stay off the politics.
Yeah.
Nobody likes my politics.
I'm not going to trigger that one with you.
Nobody likes him. But at the same time, it's not like, again, Tesla up 100% in a month before, it fell 66%. No reason why, no rhyme or reason back in 2020, right? So it's just one of those things where you do have a passive bid. The more I look at this, the more I chat with some of the guys internally, Chris and a few others. I definitely think we have, a lot of the Mike Green stuff in play with the passive bids and just limited, lighter volume in the summertime, and guys kind of disinterested. But it's not like everybody's always surprised. I wrote it in my last monthly. Everybody's always surprised when you don't see it coming. And it's usually when everybody's flipped bullish. Everybody's like, oh my God, you're so stupid. It's been bullish for so long. And the data just keeps. I mean, you can't say that the data is good. I mean, even in the housing data, as good as it is, and I know Steiner's been talking about it, and ITB's been on fire. It's one of those things where it's not all great, right? It's you have the two markets. You have the new housing market or the new builds, which are seem to be moving up, and most of the housing market's stagnant with 85 to 90% of everybody rate locked. People can't afford to put their house on the market because they can't afford to go into something else at a mortgage rate that's more than double what they currently pay. So you've got some strange dynamics going on. I will not be surprised if things crack. I don't know when they'll crack. It could be third quarter, fourth quarter. I don't know. I don't care. But I don't believe you can continue in this elevated cost of capital environment with as many bonds as are about to reprice in the credit markets, and Steiner talking about different things in the commercial real estate market repricing at higher rates. The system cannot handle that. So when it breaks, I don't know. Something will break. Now, will they fix it? I don't know. We could have that argument at that point in time too. But I do not see this ending well. But and we'll follow the signals until then.
Yeah, no, I agree. And you had a really good June letter or June monthly, which highlighted a number of the kind of the situation that's going on in the housing market and that kind of thing. It was really well written. So kudos to you. I believe it's posted on the Hedgeye website too. It got up there, didn't it, Mitchell?
I think since I came down to the wire on it, I think I published it like on the last day. I think they published pieces of it, excerpts of it, and then they sent it back to my website for people to read. So
Cool.
Actually got up fully on Hedgeye's. Obviously, I appreciate I even contributing
just for folks.
utilizing
Just for folks that.
But definitely you can get it through that link that Hedgeye put up. Definitely.
Yeah, perfect. I mean, listen, XLK is a good example. I mean, it's right at top end of the risk range from this morning. It's above it, to be honest. But now those ranges do change and are dynamic. I think one of the biggest things to be paying attention to is certainly that I'm keenly watching and am aware of, is what's transpiring in the volatility space. We've got expiration for the month of July is next Wednesday, this upcoming Wednesday, July 19th. Then you got OPEX the following or a couple days later, July 21st for options expiry for the month, right? So the monthly options. VIX, VIX one day was trading under 8. Just half hour ago, it's down at 8.21, so it's down almost 240, a little over 240 basis points on a day-over-day basis. VIX 9-day, on the other hand, is actually up slightly, up 17 bips, so it's trading around 11.55, and then you've got the VIX pretty close to the low end of the risk range today. This morning was 13.05. It's trading down at 13.35, so it's down about 18 point or 0.18, so down about 1.33%. So again, these are that the volatility complex. We really need to see, not what we need to see, but if you're going to get kind of this shift in terms of a move lower, you kind of need to see volatility, spike and hold, right? So the top end of the risk range is right around 17. So we got a 13 to 17 sort of risk range as of this morning on the immediate term trade duration. 17 still is within, the investable bucket level. So that's kind of starts at 19. So VIX north of 19 goes into the chop bucket. So I think that's something to really be conscientious about, right? As much as Mitchell, I agree with you. The data and Keith is certainly positioning the portfolio and sort of hitting the RTA buttons accordingly in terms of looking past what's happening today and looking at what could be upcoming in regards to this upcoming earnings season. Financials start tomorrow with a number of the bigger cap names reporting tomorrow, and so. Then you've got, again, you got the rest of the earnings complex really gets into underway as we kind of move into the sort of last week or so of July and into kind of the first 2 weeks of August. So it's going to be a really interesting time over the next kind of month. And I think if we're sitting here in mid-July, as we sit here in mid-August, what will we be reviewing, right? We'll be talking about VIX in the chop bucket, or will we kind of continue to review a volatility, kind of a quote unquote suppressed volatility environment? That's time will tell, but that's certainly something that I'm keenly watching. And again, I see that 1,000 FX out there. He's commented in terms of some of the kind of what do the vol players have to do, right? So if we get a spike up to the top end of the risk range, 17. Could you see kind of some pretty quick selling come in, right? They've been long vol, and it just hasn't worked, obviously. So could they be kind of quick sellers, and all of a sudden you get a bit, it's a sort of a short-lived, jump to the top end of the risk range. I think that's going to be a really, really interesting component in terms of, where are we from what does that do to price, right? Like how do we go down 1.5%, we go down 2, 5, whatever the number is, 10%, from with a spike higher, and then what does how prolonged is that spike higher? Because we had it kind of back in what was that early July, or kind of last week. Sorry, I was on holiday. We kind of we did spike up to kind of like that high 15 range, sort of. I think we hit a high of sort of low 16s, and then back in late May, that was the last time we really had the VIX up towards or within the bottom end of the chop bucket. So it closed at 20.02 on May 24th. So since then, it's really been just to lean into that whole kind of what do the vol players have to do? They've seen basically a trending lower vol from 20 all the way down to 13, 13.55 yesterday, I think is where it closed. 13.53 yesterday. So again, this is just a really interesting complex. And if you're not paying attention to the 9 VIX 9D and VIX 1D, definitely would have that on your watch list, on your radar, because we talked about this, I believe, 2 weeks ago, after Keith and Mike Green sat down, and just the volume on the shorter dated options has absolutely escalated versus what kind of the more traditional kind of VIX 30-day, which is that VIX component. That's what influences it. So again, just kind of wanting to be really conscientious as to what's happening with volatility, what's happening with price. I think coming into this week from a notebook standpoint, you needed to see kind of basically, well, if we were going to keep grinding higher, you needed to see price action move to the upside. We've gotten that the last 2 days. And so that's an interesting dynamic here. And you've got kind of volatility, again, down, towards the low 13s and low into the risk range. And just going off of your point in terms of volume, that up move yesterday was up volume on a day over day basis, plus 6% day over day, but it was minus 8% versus average volume on a 1 month basis, and minus 6% on a 3 month basis. Then if you go back on the full year, Mitchell, just from a volume standpoint, and again, you can call this dog days of summer, you can call this just money market funds and kind of just bonds in general, holding more cash, but it was down minus 21% on a 1 year. That's been pretty consistent. So in terms of like the 1 year basis, and in regards to average volume, it's been pretty much around that kind of minus 20 to minus 30 range, which I think is really a very interesting dynamic in terms of what could we see in regards to if a down move does happen, how much more how big of a volume increase could we see, right? Could we see spikes in volatility, spikes in volume, and then big moves lower in price? That's really what will kind of, to your point about triggering things in terms of circuit breaker and stuff like that. I think that's really in order to get that, you're gonna need all three of those to kind of to run through. In the meantime, though, this is to your point, the signal. The NASDAQ is bullish, XLK is bullish, ITA is bullish, Pink is bullish. As I said, a lot of these, GDX went back from bearish to neutral. Energy, XLE is neutral. So, some interesting things too in terms of like consumer staples. XLP is actually bearish trend. Utilities are back to neutral with this kind of down move in rates. That's helped XLU, but still pretty kind of weak signal there in general. So again, just like a really interesting complex.
Yeah, from the for the last 2 months, I've put a image or graphic in both my notes from Piper Sandler's Michael Cantro, and it's a correlation of S&P versus claims inverted, and basically it shows, dating back, 69, 73, 81, 90, 2000, 2007. It shows the S&P against claims, and as we know, claims have not really spiked as they very well most likely will. So I think
You're talking about continuing claims, right? Which
yeah.
come out tomorrow.
I think they're initial claims, but anyway.
Oh, sorry.
No, it could be wrong. I have to double check. I don't have it in front of me right now. But at the end of the day, it's basically tied to people not working anymore, right? So, I think over the course of time, it's underappreciated how much passive has taken over. And, in the last, even from 2020 till now, I don't know what the exact number is, but we've got to be reaching that threshold that Mike Green always talks about with the 50% threshold. And Chris actually might have at Thousand Fair FX might have the number where we are right now more so up to date than I do. So when you have these, I guess, lull time periods where people are still working, they're still contributing, the passive bid just exists, I think that is underappreciated. But at the same time, you still have the quad 4 dynamic, you still have the data dynamic, you just haven't had that break in people no longer, contributing to your 401k. So I don't think we're nearly out of the woods yet. I think that this does get bad. I think that unemployment does rise. I don't think you can continue to have employees employed as they are with an earnings recession like we're seeing year over year. Earnings recession plus, very little to no growth on the back half of the year or in the back half of the year with no catalyst per se, no save, if you will, in a cost of capital environment that's choking people. I would say macro takes time. Cycles take time, and again, it's not like we haven't seen certain things like this happen 01 to 03, where markets had a 49% rally. I think there was an 80 some odd percent rally in either 01 to 03 or 07 to 09. I'd have to double check my numbers. So, rallies do happen. It doesn't mean that you're in or out of a bear bull market just simply based upon price action. I do understand people gauge price action every day, but most people did not sell or flip their positioning back in January, just like, and then they went crickets. So now they're all back peacocking and they're still down, right? I know Keith talks about cycle to date, et cetera, et cetera. It is what it is, but I think if you put it all together, the macro framework, it just does not bode well. And right now we're riding certain trends, if you will, but I think people have to be very careful. It's one of those days where you can wake up and see, limit down and not know why. Just like on February 19th of 2020, we saw limit down and everybody's like, I don't get it. We knew about COVID from December. So why was February 19th the date that it happened? Who knows? But I would follow the signals, and I'd follow capital preservation strategies. If you don't have them in place, I'd get them there.
Yeah. My commentary on the volatility certainly wasn't not be cautious. I'm just saying that I think that's going to be a leading driver, in my humble opinion, in terms of kind of getting that. You guys basically seeing that move higher and stay higher. That was really my comment there.
Yeah, I'm with you. I was just
yeah. Other side, or sorry, 1,000 FX. You jumped on. Did I trigger you in regards to the vol talk? You're on mute, mate. You cooking dinner?
Hey, can you hear me?
Hey, yeah, man.
Yeah, cool.
You
I'm
in the
cooking,
kitchen.
yeah.
You cooking?
I'm in the kitchen.
Yeah, that's gonna be a fun new show. A little cooking with Chris. Cooking with Chris, talking
I don't know.
all sorts of markets and butter chicken and whatever else you make.
Yeah. I wouldn't focus on the food. I probably wouldn't focus on the markets either. It did make.
We can just talk
It did
about
make
F1 if
me.
you want. Yeah. No, I'm just kidding.
Yeah, we can do that.
All right.
It did
Sorry.
make
I'll
me
stop.
chuckle that like 12 weeks ago, there was a grown man crying on TV about his stock portfolio. That made me chuckle. Not that. I mean, I'm not attacking anyone for their mental health or anything like that.
No,
This is a safe space. But
they always come out of the woodwork very, very quickly when things start to go bad, and then they peacock when things are up. But it's amazing how quickly they do cry.
Hi, Robert McGroarty here, Director of Subscriber Development at Hedgeye. Hope you're enjoying our podcast. Start generating alpha with our suite of Sector Pro investing research products. Dive deep into retail, industrials, technology, and everything in between with exclusive access to the sharpest analysts and actionable ideas on Wall Street. Go to hedgeye.com/research to subscribe. Enjoy the rest of this episode.
yeah, I think just Mitchell, to your point, the last thing I heard Mike mention it was, we were just under 50%. It's like 47% or something passive. What's the right word for it?
Yeah,
But
that's huge. His
it's
threshold is 50%, and he always talks about 50% and how the volatility in both directions can go haywire.
I think it came up for everyone that heard the real conversation with Mike and Keith. He did mention, Keith at the time was talking about, I don't know if he was talking specifically about IWM or something else, but Mike did say you need to you need to reconsider your thoughts, because he made a reference to spy monkeys and everything, blah, blah, blah. And he did say you do need to reconsider that, and part of that is I've gone back and reread a lot of the stuff that I initially read when I first started listening to Mike Green and his kind of thesis, and going back and rereading it after a couple of years of, learning some more stuff. There's the way I've described it before is, let's say 2022. So Mike Green's thesis is in 2022, nobody really sold except for target date funds, but that wasn't driven by any kind of redemptions or anything like that people were losing their jobs or people were taking money out of 401ks or anything like that. It was purely driven by the fact that 50% of the market is forced into target date funds, and the Fed killed the bond half of the target date, which meant the target date fund had to rebalance out of stocks to rebalance the portfolio. So now that we're kind of where we are now, it is that a part of it's kind of a Bitcoin thing. It's kind of a stock to flow thing, right? So if Vanguard and Fidelity, and you guys can tell me who all the other passive, the huge passive guys are, right? But if they're not selling, then the example I've used before is if there's 1 million shares of Apple, but Vanguard, Fidelity, and whoever else own 800,000 of them, and they never sell them, well, then you can only ever really buy 200,000. But on the little thing on Yahoo Finance, it says there's 1 million shares of Apple outstanding, but you can never buy 1 million. You can only ever buy 200,000, right? And that's kind of the whole point that driven Bitcoin was, okay, I need to buy, but there's a huge chunk of people that will never sell it. So you can never buy the whole float. So there's a load of papers and everything written with the fact that actually we all know that Apple makes up the largest component. So straight away, if you buy some kind of ETF that's linked to the S&P 500, you know that whatever it is, 7% of your money is going into Apple. But not only that, there's and I can link the paper later. It's linked on my video that I did on the spaces that I did with Mike Green on I think it's my, and I linked all the papers that he references.
I'll find it, Chris. Yeah, you tweeted it too. I'll go find it.
And in that, I'm not going to be able to remember the guy's name, but the paper that he wrote, he said that actually for every dollar that goes in, is effectively has the buying power of $5 because of this stock to flow dynamic. And actually, he then later said that he actually downplayed that in his academic paper because he didn't want it to be laughed at. He wanted it to be taken seriously. And depending on the stock, it can be anywhere between 5 and 20. So effectively, for every dollar that goes into a stock, it has the buying power of 20, right? So outside of any other kind of external vol shocks or anything else, or banks dying, which was only happening 3 months ago, outside of that, you have this constant drip of money just constantly coming in, and it has an outsized impact. And the other part of that is, you have things like the people who were short or people who weren't in now have to try and chase their benchmark, right? They are so far behind the benchmark that they have to chase it. So what are you going to do? Are you going to pile in to buy in the underlying, or are you going to risk premium and just buy calls? And calls themselves have outsized impacts on the underlying market, right? So if you're going to chase it, you may as well chase it with calls. And if you already had the stock, you can sell some of your stock and say, right, okay, this has moved a lot in 6 months. I'm going to take some off the board. Let's say I'm going to sell 20% of my portfolio, but I'm going to play the upside with calls, just do stock replacement and cover it with calls instead. So all of these dynamics are at play, and any one of them can stop or start at any given time. With hindsight, you can say, oh yeah, it was this and that and blah, blah, blah. But there are all these underlying dynamics, and Keith says it all the time, like FOMO, like US stock FOMO, right? But like these dynamics aren't the same in other markets. And if you look in other places, I mean, today with the dollar move, okay, that's kind of the other markets perhaps do look like it now. But what I mean is if you do look outside of the US, it doesn't quite look the same. It doesn't mean you can't play it to the upside, but yeah, I've rambled on.
No, it's super insightful, Chris. And the conversation, so up in the nest, and folks have asked, like, how can I find the nest? So if you're on Twitter Spaces and you're either listening to the replay or you're here live, you just kind of basically pull the screen down a little bit, and you'll see sort of basically a number of tweets. So I actually just put in the nest not only Chris's fantastic conversation with Mike Green from back in late May, but then also all those articles that you and papers that you kind of were referring to. They're all up in the nest, so you can just click the link, and it'll take you straight to those papers, which were great reads. I actually hadn't read them until you called those out. So thank you again for sharing that. It was quite fascinating in terms of what the fact that they were downplaying it was even funnier. Mitchell, you went off mute. You had something to add? Guess not.
Hey, Robert.
X2, you jumped up. What's up, buddy?
Chris was talking about guys, getting on and crying about their positions. So that kind of tweaks my interest. But Chris, I wanted to ask you, would the same thing apply if you take like the State Streets and BlackRocks and those guys, they have holdings of international stocks, international funds. It's going to be the same, I assume, the same concept with those securities as well, right? Not just the U.S. stocks.
Yeah, but I think like if you take the UK as an example, I guess Japan as well, because you have so many dynamics that drives it. So like if you take the UK, you take the FTSE, it's a massive dividend payer, right? We don't have, not that we don't have it, but stock buybacks are not as prevalent, which is another factor that you're reducing, you're reducing the stock. So you're having increased buy-in in less tickets available. Now I know you've got like nominal dollars and everything, yeah, I get it. But to the same extent, you don't really have that same factor. The same goes for options. You don't have the same underlying drivers in terms of options flow, just pure volume. Like I was saying to guy, we have a separate chat in the background, and I was saying, well, I can trade in the UK, like I can trade Apple 24/7. Well, 23/6, I guess. I can trade SPY all the way through the night, which you guys can't. But the fact that I can't trade a UK stock outside of normal trading hours, but they provide futures for the FANGs, SPY, Qs. You just have all this external volume and demand that you just don't have for the other things. There's not like, maybe, I don't know, you might have the same. And you do have the same for like Alibaba and stuff. But what I mean is you don't have the same volume demand for, I don't know, I'm blanking, but insert, generic international single stock name here.
Yeah, I know what you mean. It's not the same to the same extent, but it happens, but not to the same extent.
Yeah, so the equivalent could be Japan, right? So, fair enough, Warren Buffett's gone in and bought the exchanges, or, bought shares in the exchanges and done it that way. But prior to this, I think I made the same point previously about gold. It was kind of like, in the big run up in 2020, when everyone was scrambling because gold miners were completely off of their radar, any future potential run in gold and in that gold miners, you wouldn't have touched gold miners for 10 years, and then they had this big huge run in 2020. So people would have sent analysts to go and pick which ones. So that work's already been done. It's it's 2 or 3 years old now, but the work's been done. So recently, like who had gone out and done the work on individual stocks in Japan? Well, no one. They're probably doing it now, but what can you do when you see a breakout in Japan where you can buy EWJ or you can buy the Nikkei futures, right? So whatever comes forward is, what I'm trying to say is whatever comes in the future, if there's a pullback in the Nikkei, let's say, like there was at that point in gold, gold came off, the gold miners sold off and kind of have been forgotten about a little bit. As we're moving forward, then the next one, you've already done the work. You've gone out and tried to find, what was that? What were those 6 stocks that, at the very least, what are the 6 stocks that Warren Buffett bought? Oh, these, right, okay. Right? So then you don't have to buy the futures, you can buy these 6 stocks, and then you can spread it out. So some of that volume, as we're moving forward, will spread out into other places.
Hi, Robert McGroarty here, Director of Subscriber Development at Hedgeye. Join our entire research analyst team live before the market opens for deep dive investing analysis, our favorite stock ideas, and our risk manager in chief, Keith McCullough's macro overlay. Our team of 40 plus equity analysts discuss key market developments, trends, and our high conviction long and short investing ideas. You will not get this granular level of insight anywhere else. A video replay, audio version, and analyst summary notes from the call are available shortly after each live show to ensure you don't miss anything. Go to hedgeye.com/research to subscribe. And tune in live to the call weekdays at 7:45 a.m. Eastern. Enjoy the rest of this episode.
I think this is interesting. I missed maybe 2-3 minutes. I had to jump on a quick call, but this whole dynamic, and a few of us have talked about it behind the scenes. It's pretty interesting. I know Keith bought the top 50 in the S&P that ETF. But if we track the S&P top 50, but then we track the top 5 of each ETF, of each sector ETF, the strength or the signal strength that some of us see is much stronger in the top 5 ETFs than it is in the S&P top 50. And I think that largely attributes to what Chris was talking about and what I mentioned earlier is the top 5 weighted each ETF get the lion's share of the money that's coming in. So as long as the passive bid keeps coming in from, everything from buybacks to people still being hired, if you will, or still being employed, that those stocks get the largest lion's share of the money, and it has, as Chris mentioned, the largest impact on those where $1 can equal 5 or even 20 in terms of a multiplier. So I do think that it's interesting to look at. And maybe those stocks take over the world when you have full employment and people paying or people paying into their 401ks, et cetera, and you got buybacks at full force. I do think it's interesting. You tend to see the weakness in quiet periods when companies can't buy back their own stock, and then the strength seems to come even in the face of shitty earnings. The strength over the last 3 quarters has to come once companies have gotten out of their quiet period, once they've released their earnings, and then 48 hours after they release, they can start buying again. So I do think that cycle has been kind of interesting to watch. So I definitely think that given the rise of passive now being closer to 50%, the employment factor is much more prevalent in the conversation. And I wouldn't be surprised to see I wouldn't be surprised to see the weakness come in the face of people being let go. And I think Steiner mentioned you won't see certain things in non-farm payrolls until unemployment gets to 300,000 jobs, et cetera. But it is trending higher, even though we're it's 240 or whatever, 237, 240. It's troughed at 180 in September, October of last year, and the trend is moving up, and people are losing their jobs, and those who have gotten severance packages, they're now starting to roll off the severance packages because some of those packages are anywhere from 9 months to a year, and they're starting to find themselves in the data. So, I get where we are now. I at the same time, certain dynamics may be keeping things higher, but again, this is where people go. This is why people never see it coming. This is why people don't get it. It just, they're so focused on, this is up this amount and this is up this amount. Okay, cool. What's the data say? What is your capital preservation strategy to get you out? And then you go from there. If you still never got out from the cycle highs, you're still down. Even with the S&P, or even with the S&P up 16%, you're still down. Even with the NASDAQ up 34 or whatever percent, you're still down from the cycle high. So have that capital preservation and strategy in place, and then, cut and just stay out until the trend, comes back. But definitely protecting the downside is very important when things do turn. Until then, ride away.
All right, so we're coming up on kind of like the 45-minute mark here, or we are just surpassed it. So if anybody is listening in, if anybody wants to jump up, got any questions or commentary, obviously, we've got a couple really very solid Hedgeye Jedis as speakers right now. So thanks again to Other Side Asset Management and Thousandaire FX for contributing here this midday weekly notebook review session. We've covered a lot. So Bitcoin is something that we haven't talked about. It's catching a bid here midday, which is interesting. So that's something to be just basically you're seeing a lot of risk on assets basically really moving higher. I mean, Bitcoin, as I said, Bitcoin just caught a bid, high yield growth, HYG, which, Keith hit the button on the short side. That's having a pretty big day. It's up. It's a big move. Sorry, it's up 43 bips. So again, for HYG, it's pretty good move. Good move higher. TLT is also catching a bid here with USD. Sorry, not USD. With US 10-year and the 30-year down towards the 30 years, not quite at the low end of the risk range. 10 years certainly, pushing down towards it. That low end of the risk range was 3.72 this morning. We're sitting at 3.777. It's down about that yield is down about a little over 2% on the day. The 30 years sitting around 3.90, and that the low end of the risk range is 3.80. So interesting moves here on certainly on the bond complex, fixed income. You saw, as Richie noted, in the top three things this morning, the 2 years certainly has taken out kind of and the market expectations have taken out a rate hike later in the year. So really just expectations are for 125 basis point rate hike. You got that I saw that out of Goldman as well, actually, yesterday. So thanks to my buddy who sent me that little blurb out of Goldman in terms of their rate hike expectations. Goldman's expecting it to kind of go to 5.25 to 5.5, and then to kind of hold there. So certainly higher for longer is the kind of the consensus, I guess, but it's just a matter of does the Fed continue to ratchet up? Basically rate increases in the face of sort of a stagflationary, as other side kind of alluded to, and certainly Steiner did as well this morning, into a bit more of a potentially stagflationary environment. That's going to be an interesting component here. And the other thing too, just from a kind of again, just along those lines from an inflation standpoint, we are seeing, or our estimates are, we obviously just got the data for Q2, so that is actual at 3.98 was the actual for the CPI year over year. We are projecting, as I've talked about here a number of times, and we've certainly talked about on macro show, et cetera. But really, we are kind of seeing a bit, certainly our estimates are seeing a bit of a stagflationary environment where we're going from 3.98 today, or sort of for Q2, down to our estimates have it at 3.40 in Q3, and then really kind of flatlining around 3.27 and 3.28 in Q4 and Q1 of next year. Consensus has that kind of drifting lower, going from 3.50 in Q3 down to 2.80 in Q1 of next year. So again, I mean, not a huge difference from a delta standpoint between the two, but certainly it is an interesting thing to be thinking about. And same with GDP. We're still definitely not, I won't say in line, but certainly have different estimates from a Q over Q standpoint. Our expectations remain. I just want to get the right number because Drago sent it over, I believe, this morning or last night. So our Q over Q, so our GDP on the U.S. side is minus 113 basis points versus Atlanta Fed GDP now model at plus 229 bips, and consensus estimates at plus 130. So another quarter here, kind of like Q1, where we got a pretty big delta between us and sort of estimates and the Atlanta Fed. We are seeing, kind of come a bit more in line in Q3. We're seeing a little bit. Well, actually, we're looking for a bit more of a growth year, though. Q4, Q1, kind of definitely the delta shrinks. So it's going to be interesting as we kind of see some of these numbers roll in terms of how's that going to impact kind of what Q2 was on the board. Do we get kind of another sort of shift to maybe a quad one environment where inflation was down but GDP is flat? Certainly, the model is saying that's not the case. It's going to be a quad four on the board, but things stay the same. In terms of our model and the estimates, you're going to see a quad, or you would see sort of a quad one on paper, at least in Q3 here. So we haven't quite rotated the model yet, and it's still it's kind of like an estimates and actuals for Q2. But you are going to kind of start seeing that sort of get priced in, and who knows? I think to your point, Mitchell, there's a lot of very interesting and negative data out there. It's just a matter of, how does that start to flow into the signals and that kind of stuff. So yeah, but anybody out in the crowd, if you guys got any questions, feel free to jump up. I know it is midday, it is lunch, so maybe for anybody who's at work, what have you, might be just on listen only mode, which is totally cool. But Mitchell and Chris, is there anything else? I know we've talked a lot, and we can certainly wrap it up here at the hour mark. But anything else kind of on your minds at this point in time?
I don't know. I haven't been on in a while, so I don't know what's been said. I do catch a handful of the rooms. Hedgeye signaling's off, and this. I don't know. It hasn't been perfect. Nothing is. At the same time, I would say some of the signals have been actually really dead on. It's just a function of have we listened, right? So, the XLK signal I didn't listen to. I didn't listen to the Apple or the Microsoft signal, right? But it doesn't mean that they didn't go bullish, trade, and trend. Sometimes, Keith has his process, and when you are subscribing to the Hedgeye model, right? Hedgeye has their process, and they always say utilize the Hedgeye process in with your process. I can't speak for Keith. I don't know why he does certain things that he does, and I would never try. I could only speculate or guess that Keith's process, XLK is something that doesn't perform well in quad 4. So even though the signal itself is moving one way, he's still going to stay away from it because he has the history of seeing things go limit down multiple days in a row when you least expect it, right? So he's going with the highest probabilities. It doesn't mean that you can't play the signal itself and just remove what Keith is doing from the equation. The signal nailed it, right? So I'm not saying Keith's right or wrong. Keith is investing the way he invests based upon his process, incorporating the quads in with the signals. But if you wanted to buy, Meta when it went bullish, trade, and trend, it went bullish, trade, and trend, right? So I think that's all part of utilizing the Hedgeye process. I've definitely gotten back more to signal. I've definitely gone back more signal driven, if you will, large in part because I do think that the Mike Green passive investing scenario, I think Chris is a big believer in it. I am as well, based upon the reading and the research we have. I mean, it's what's your bias and remove your bias, to roll off what the signals are saying. So you can fight the signals, or you could roll with the signals. You can, just because Keith doesn't do something or does something doesn't mean that the signal is completely bad based upon what I've seen. So that's the only note I'd throw out there. Again, I don't know what's been said. I just pick little bits and pieces, but you can't say that Microsoft and Apple and Meta and a few of the others didn't go bullish, trade, and trend. Now, some you might question and be like, how did that not go? I don't know the answer to the question. I'm just observing based upon what I've seen certain things do or not do. So that's all I would say.
Yeah, appreciate that. Yeah, I think that's really well said, especially from a power user like yourself. And the other component there too, I think, is definitely time horizon, right? Like what everybody's got a slightly different time horizon. Some folks are day traders, some folks are much more kind of trade duration, so shorter term. Some are much longer term, right? In terms of 3 months. I know many RAs or investment advisors out there really kind of have kind of a quarterly to sort of 3 months to 3 years, sort of something between that trend and tail duration in terms of ideally how they're kind of positioning their portfolios. And there are different signals, different kind of dynamics within the product set certainly lend to various different investment styles. So I think that was really well said, Mitchell, and appreciate that. But all right, well, doesn't seem like many folks are jumping up, so we'll just wrap up, I guess. And again, apologies or thanks for the flexibility here, a little summer schedule. just kind of these yesterday we had a last minute change in terms of how to go take my son to pool party, birthday party, which was a lot of fun since it was like 92 degrees here in the Northeast, and I got to dunk off the diving board, Mitchell, which was always a great time. But then this afternoon we got a little soccer practice, and next week we got a big internal kind of meeting for Hedgeye. So I got to kind of figure out my schedule, but we may end up doing kind of a similar sort of midday thing on Tuesday, because Wednesday, Thursday are going to be and Friday are going to be pretty busy. But again, thanks again for everybody tuning in. This is the weekly notebook review, July 13th, and we'll see you around soon. Good luck trading out there and the rest of the afternoon. Cheers.
Don't forget to check out Hedgeye.com to get more actionable investing insights from our team of more than 40 research analysts. And check us out on Twitter at our handle, @Hedgeye. This presentation is informational only. None of the information contained herein constitutes an offer to sell or a solicitation of an offer to buy any security or investment vehicle, nor does it constitute investment recommendation or legal, tax, accounting, or investment advice by Hedgeye or any of its employees, officers, agents, or guests. This information is presented without regard for individual investment preferences or risk parameters and is general, non-tailored, non-specific information. This content is based on information from sources believed to be reliable. Hedgeye is not responsible for errors, inaccuracies, or omissions of information. The opinions and conclusions contained in this report are those of the individual expressing those opinions and conclusions and are intended solely for the use of Hedgeye subscribers and the authorized recipients of the content. All investments entail a certain degree of risk, and financial instrument prices can fluctuate based on several factors, including those not considered in the preparation of the content. Consult your financial professional before investing. The information contained herein is protected by United States and foreign copyright laws and is intended solely for the use of its authorized recipient. Access must be provided directly by Hedgeye. Redistribution or republication is strictly prohibited. For more detail, please refer to the terms of service at hedgeye.com/terms of service.